Good morning, everyone. I don't know if you heard that. The new voice said this meeting is being recorded. That was like really loud. But anyhow, welcome to the morning brief here on Tuesday. Okay, sounds good. You can hear me. Yeah, the technical issues this morning. Just got home late last night, obviously. You know, I've been on the road. But yeah, so we're working through some issues this morning. I think everything is finally up and working, but we'll know here in a little bit. But a fantastic long weekend, if you will. We had a team breakfast yesterday in the hotel, or actually no, yesterday I couldn't find a place to do it because of the small hotel we were staying at in Spokane. But if you didn't catch up on Facebook, big weekend for one of my daughters. Got picked up basically for the Junior Olympics. It's got a new program name now. So we're going to go out to California for a week this summer and train with some of the best out there, a bunch of Division I coaches. So that's exciting. And that same weekend that her team won the gold ball, which is where you take first place in your division, which neither of my daughter had ever done that before. The national qualifier had a team that finished first. So pretty cool. We've actually, now there's a gold ball. So we got to actually touch one. I've not even been able to get that close to one before. So pretty cool. But anyway, back to what's going on in the market this morning. We're going to talk about, first of all, market was a nice green day yesterday. Nice setting up for a nice green day today, which is pretty cool. There's lots of headwinds and tailwinds in the market, but right now the tailwinds are kind of have subsided, if you will. We're going to talk about leverage this morning. Leverage, MOIC and IRR. I wouldn't say they're advanced concepts. You need to kind of understand that sort of thing when you're talking about leverage. So leverage, just a quick example, like with your house. You know, I say people, leverage isn't necessarily evil, right? It's like fire. Fire is not bad. You do need to pay attention to what you're doing when you are utilizing fire. Chainsaws are not bad, but you do need to pay attention to what you're doing when you're using a chainsaw. Right. And we all have that same level of, you know, if you're teaching a child, like both of my kids have used our little tiny chainsaw. It's like, okay, very controlled environment, one step at a time, that sort of thing. Well, leverage is the same way, where you can use it and use it to your benefit. It is a fantastic tool, but misused, and you can knock yourself out of the game, if you will. And I was reading, the reason I'm talking about leverage this morning is because in the crypto world, some of these websites that are not US based, but remember, crypto is international, right? So when you're in a US stock market, you're controlled by US stock market rules, and you may be like, these are BS. Well, it's for your own protection, right? So that's why we have them. Well, when you think of international stuff, you don't necessarily have the same protections that you have in a US market. So what does that mean? They're allowing 100 to 1 leverage. 100 to 1. 100 to 1 leverage in crypto. Okay. So to put that into context, if you open a margin account here in the US, you get 2 to 1, right? Twice your money you can actually use in the market. And once you become a pattern day trader, you can bump that number up to a whopping 4, not 100. OMG. And for those that have actually traded and started hitting the buy and sell button with a significant amount of leverage, i.e. 4, yeah. Holy cow, right? You've seen how that can really move your numbers, good or bad, right? So pay attention if you're doing that. Imagine somebody who's 18 in some foreign country using 100 to 1 leverage. You don't think they're going to get burned by that? I mean, a lot won't. I'm not saying everybody will, but there's certainly going to be some casualties of actions like that. So just kind of insane that they're offering that level of leverage, and that would just not happen here in the U.S. Yeah, leverage of on the golf course. I'm looking at some of the comments here. The Bitcoin ball and be no longer physical. No, this is a physical gold volleyball. It's pretty cool. Gold painted, right? So anyway, back to leverage. That's what we're going to talk about this morning. When people are like, I don't use leverage, I'm like, oh, you pay cash for your house? And they're like, what are you talking about? And I'm like, well, you have a mortgage, use leverage, right? If you buy a $250,000 house and you put $50,000 down, you just leverage your way into that house. If the price of that house drops in half, you could sell it and owe the bank several $1,000s, right? So yes, you are using leverage. You just are very comfortable with it because you understand it and think that that's not going to happen, but it can. Anybody who lived through anybody who was a homeowner or paying really close attention during 2008, you saw some of that stuff happen. But it works to your advantage too, right? If you buy a house outright for $250,000, pay cash. Good for you, pay cash. And you sell it a few years later for $500,000, you've made 100% on your money, right? Or if you lever into the house and good for you, 100% over 4 years. If you lever into the house for 50,000 and then you sell it, 4 years later for 500,000, you've made $250,000 on your 50,000. That's called a 500% return. Okay, so if you are interested in your return of your, return on your investments, you wouldn't pay cash for your house. You just would not do it. So anyhow, that's what we're going to talk about today. I do need to get things set up, so let's get started right now. If you are catching us on replay, thanks for checking us out. Make sure you hit both subscribe and the notifications bell. If you want to catch us live, it's $25 a month to come into the room. And with that, let's go ahead and get started. All right, welcome back, everyone. Here's our lineup card for today, Tuesday, May 25th. All right. Make sure you have your window set up, your chat window and your Q&A window set up appropriately. Also, this reminder is the financial education presentations. You have to do your own due diligence for acting upon anything you hear this morning. Full disclaimer information is available at ototnow.com. That didn't share out, so why? There we go. That is not it either. Technical issues, bam. No, still not going. Why is that not sharing? Says it's sharing. Yeah, normally I get a green box around that. Let me know that's sharing. So if you don't see the OTOT lineup card, let me know. Otherwise, I'm assuming it's correct. All right, our mission objectives today: grow our money, protect our money, live off our money. Really, when you're talking about leverage, you're talking about growing your money. You're not talking about protecting it. You can use a hedge, if you will, leverage hedges to protect your money, if you will. But most people are talking about growing your money, right? Or even, protecting it. By not using leverage, you can protect it because you're not taking the additional risk. But for our tactical objectives, we're going to talk about terming using leverage. So first of all, why would you use leverage? Well, you either don't have the capital. Okay, you just don't have it. If you're trying to buy a Bitcoin and it's at whatever 40,000 today, or a stock of Amazon at 3,200, and you don't have $3,200, well, leverage would allow you to buy the stock if you had a fraction of that, if you will. So that's one reason you would use leverage. There's also options that are out there as well. Or you just like when you buy a home, you don't either have the money or want to use the capital in that manner to be able to get into your home. So, a lot of us, if you're out there, especially with home prices here in Austin, if you're looking at a double, remember the tax code, if you're married, you have 500,000 of gains, that's free. But if you get over 500,000 of gains, you're going to pay taxes on top of that. So certainly you would leverage that money back out of your house by getting a cash out refi, which is tax free, and then selling the home, right? And then you don't have to pay those taxes. So, so some advanced concepts, but leverage allows us to get into those arrangements to be able to do the really smart and efficient thing. Or if you're trading, you're going to use leverage, right? Because you're going to buy a large amount, as much as you can buy, for a very small stop. right? So, and by managing your risk unit, we haven't talked about it in a while. We should probably cover that again at some point. The number of shares times the stop is the risk unit of dollars that you're risking. Well, you may need to buy a whole bunch of shares, and you can use leverage to do that. So that's also, you can, if you are taking say you play volatility, the VXX is a one lever, but the UVXY is a triple levered ETF. So if you are in the commodity space, volatility is not a commodity, but if you are in playing gold or silver, or I'm trying to think of fuel, gas prices, another one. If you are using those instruments, there's index funds that track those, where you can go like Dig and Dug. That's the oil ETFs. I can't remember which one's long, but I think Dig is long and Dug is short. But if you want to lever that up and triple your returns either way, there are options to do that. So it's kind of crazy. VXX is a house of pain. UVXY might be considered the city of pain. Well, I tell you, a volatility play, I mean, it moves. So if you hold it, you just don't even look at it when it's down. And you don't even look at how it's affecting your portfolio. You are simply waiting. And again, I still have VXX that's back down, but I don't care, right? Because I know that in my lifetime, that is going to spike back up. And whenever I have those dollars that are kind of off to the side as a hedge, when volatility spikes, that's when I'm going to exit a portion of that, like I did when it was back up in the 40s, almost touched 50. So anyhow, you hold that stuff. It's a hedge. Don't worry about what it's saying about it's hard to look at your net worth every day in the Schwab app, but and see it falling, but it's not really, right? Because that is a specific tool for a specific reason in your portfolio. That's enough on that. So question of the day, we'll get in MOIC, which is multiple of invested capital. So thinking of the house example again, if you buy a house for $250K and you sell it for $500, that's a 2 multiple of invested capital, right? But if you buy it for $50K and lever the rest through a mortgage and you sell it then for $500K, you actually made $250,000 on your 50. So that's a multiple of 5. So internal rate of returns, taking a MOIC and now spreading that out over time. So if you took 20 years to do it, the return's not that great. But if you take 4 years to do it, the return's a lot better. So that's how that calculation works. We'll get into that a little bit after the open. Standard flow, non-standard, because I got a late start. So we'll just cover the market here, then go right on into the open. As far as the open, you can set up for, I have Tiger long. I like the longs better than the shorts. Tiger, FINV long, and then RIED short, pretty good short out there, if you will. So we'll get to that in a second. All right. Let's take a look at the headlines real quick. Skip TD Ameritrade there. You can see the futures are in the green. Asia's mixed, not a whole lot going on. Europe was mixed, not a lot going on. Asia kind of up big, so I bet we're feeling a little bit of that here in the market. Bonds down below 1.6. Oh, inflation's dead all of a sudden. It was never that big of a deal, but boy, did it catch some headlines there for a while. When I say it's not a big deal, you're probably wincing going, yes, it is. It's like, well, it's a little bit of a deal. It's no big deal, but and then crypto selling off again, but we're kind of getting off the crypto theme, so we won't start talking about that. All right, let's go over to TD Ameritrade and set up here. 4 screens in front of you. You got Tiger, and then we have FINV long. Oh, that doesn't look as good as it did before. RIDE. Let's actually take a look. Instead of FINV, look at GOTU long. All right, setting up for the market open. Good morning, everyone. Welcome to the On Time On Target play of the day. You have 4 screens in front of you, and here we go for the market open. And we're off. Speaking of being off, I did get to go to Churchill Downs on Friday. That was kind of cool. Was in Kentucky for a speaking gig. All right, looking at on the far left, you have the SPY, which is the 1 minute chart there. These are all 1 minutes. You have TIGR here, which is long, that beat earnings. You can see it there. Long and going longer here, already kind of raging higher. You have GOTU long, which is here up 6.5%. not nearly the volume that you get in these other names. And then over here in RIDE, this is gapping down hard, but it's out of our range. So I'm not going to take it because it's out of the range. And when you think, why would I not take it here? Well, even if you set it up, if you're going to take it, you kind of have to take it now. So even if you took it here at 8:10 and covered up at 8:30, 20-cent stop, here's the issue. So say it's bouncing at 8:10. So say if you take it, we're not taking it, but just put this here. You have to put your you have to stop above the high of the day. You can sneak at 8:25, but at a 20-cent stop. So and getting in at 8:10, so basically 3x to the downside. This thing has to fall all the way to $7.50, and that's just unlikely. Now it's probably going to do it while I'm talking, but it's just because that now means if $1.70 is 17%, and it now has to drop another, what did I say, 60 cents. That's 1/3 of that. So that's another 6%. So that would have to, so the name would actually have to fall down 22 to 23%. I'm giving a little bit of less because it's already below the 8:10 mark. That's why it's so tough. But if you have something that's up 4% and you're looking at, a 20-cent stop and 60 cents, then it only has to go another, 3.5% higher, which means it has to be like 7% on the day. So that's why I don't take it when it's that far down and it's out of our window. I studied that in my PhD dissertation work that never got published. But that's exactly what I was studying, is if it's down here in the less than 5% range, you don't get enough of an emotional event for it to move. But it's over 10, if it starts over 10%, then you just don't have the math that supports you getting to the 3R point. If all of that makes sense. Said that kind of fast. But I don't really like any of these. Tiger moved up too much. GoTo is really not performing. Let's go back to FINV, which is a Chinese fintech firm that beat earnings, just low volume here. So kind of a tough entry, and then Ride has gone down too much. If you see over any other long, no worries for explaining that. If you see any other longs or shorts, so what can happen, Apex, specifically on this one, since you threw this at me last night and I started looking at, the more it sells off is a problem. So as you and I used to do literally the trading room I was in, she would put stuff out the night before, similar to that. You're like, hey man, I'm optimistic about this in the morning. Well, if you send that out, because it's here and then it continues to sell off, it can actually work against you, right? Because you end up with that, well, crap, now it's sold off pre-market too much. And that's where sometimes if it would get really juicy, I would take a half size. I would take half of the R pre-market, especially if I was just like, man, this is awesome. It's going to drop like a rock. So if you saw this in this range pre-market, you could go, well, say your normal R unit is $300. Well, I'll do my math and I will take basically 150 of it ahead of time, right? So whatever your shares end up being for the math there, you take half ahead of time and then wait for the market open. That way, if it does just drop, you have your R units just, you hit your 3R point, you'll make half as much as you normally do because you only risk half an R. And then you try to snag the rest at the market open. So I haven't talked about that in a while, but sometimes if something's really juicy, I will take some of it pre-market. And sometimes I don't even do the math. I'll just pick up like 1,000 shares pre-market, just boom. And then I'll do the math to figure out exactly what kind of R exposure I have on the day. All right, so Tiger's raging higher here. No real opportunity to get in that unless you just take it at the open. But man, that thing is screaming higher. I don't even know what they do. FinViz, you just don't have the volume. FinViz, FINV, it's not FinViz, but it's FINV. And then Ride, kind of too far gone. If anything, you would need this to back up to like 850, which I doubt it would. But if it does back up to 850, now all your math works, right? And maybe you get a 15-cent stop in here, and then you can turn around and short it. And so if you were in at 850 with an 865 cap, that's 15 cents. So then your 3R points actually back down in here, right? So that it helps you with making the math work on the chart. So, all right, blah, 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 trade. Let's get back to where we are. I'll pull that up. Here's the SPY. So again, things were gloom and doom. The world was ending here a couple times when we bounced off the 400 level. Oh my OMG, all that stuff, it's bouncing back up. I would still say in the big picture, this is congestion. The market could go either way. The headwinds on the market are obviously taxes and inflation, which are big headwinds. I'm not going to, taxes has kind of been out of the taxes has been out of the news cycle, and it's been all inflation talk. But that kind of got dampened down. The crypto thing kind of stole the headlines for a couple weeks. That is starting to die back down. There is some talk about a US digital dollar, which would probably be pretty smart. And then if the US would do that and make a digital dollar and actually peg it to something, i.e. like returning it to the gold standard, that would be interesting in the fact that it probably would kill off all of the other cryptos, just drive them to zero because you wouldn't need them anymore. And the digital dollar could now be the new standard of the world instead of the fiat dollar, which we kind of tend to overly inflate, if you will, because we keep doing deficit spending and things like that. All right, let's look at what is on the move today. All right, I'm refreshing another screen. So see where we are here. Yep, in the green across the board. So you have DraftKings. DraftKings was up pretty big yesterday, actually. Putting the thing back on here. So DraftKings was dead money for a while, right? So it went from like $80 all the way down to 40 some and kind of bounced right here. So this was that big move up yesterday in DraftKings. I'm not worried at all. Now, people do get worried when things chop in half, because if you back this out, that was up at, I don't know, 80, 75. So yeah, it's catching a lot of flack, especially during this. It's like, what's going on with DraftKings? I'm like, well, DraftKings is DraftKings. So, either you think legalization of gambling is going to go nationwide. You think people are going to keep doing it. Yeah, I do. I think all of those things. Didn't really add because so many people were worried about it. But if they weren't worried about it, I would have added here. But yeah, I think this continues its climb back into the 60s, 70s. I'm not worried about DraftKings at all. That is something, if somebody has a question, be like, I'm not worried. Just move on. All right, Delta Airlines, I wouldn't touch an airline. I mean, obviously it's in the book, but not by choice. VIP Shop bouncing. NEO's kind of interesting. So NEO got drugged down from, up here in the 60s, excuse me. I do still think it's the premier automaker. That they've not actually made any cars. Zero. They actually subcontract their manufacturing. So that's a little concerning to a company called JAC, but they retain, I think, 51% ownership. But anyhow, so you have NEO that was setting new lows, new recent lows, if you will, here down at 301. It's bouncing nicely. I do think with China has a goal of going all electric. That's a published government goal, unlike in the US where we're incentivizing it, but it's not a goal. So with a published goal to go all electric, I think you can put some money behind this. The competitor that you could say is better, I can't tell the difference between the two. I like NEO just a little better, is Li Automotive and XPeng Motors, XPEV. So kind of following a similar chart, right, for XPEV. And then you also have Li, which is Li Auto. So these all trade the same. So they've all lost over 50% and now they're bouncing. So, or you just go, let's see, Q Clean has them all, including Tesla. So again, same chart, right? Except not as dramatic because it's been checking out. When you think from the election, so went into Q Clean around the election, which was here at this level, it basically has returned to where it was from the election. So if you were in this and watching it, you watched yourself make money. And people forget this part. All they remember is how much they're down from the high, right? So they forget all the money they made in a couple months they had it, but then of course it's now back here. So you're about even from where you entered it likely. All right, Revive Therapeutics, Palantir has been on fire lately, PLTR. So it's been bouncing back all the way down to 16 here. So nice move up in the past couple days, even though I think it gets back up in the 40s, maybe not anytime soon. Probably take a couple of quarters of earnings. Win's another one, I like. Several of you are in Win. Trying to pull this up, WYNN. So got a nice entry point back in here a couple days ago. So part of the reopening trade. I'm not much for the reopening bets, but I do like the fact that Win caters to the high crowd. The mass affluent and above crowd. So you get a little higher margin, a little more reckless gambling with fun money at the Win versus straight Caesars. Caesars has been on fire too as well. All right, what's on the downside today? REAXF, Clickstream, TQLB, some other kind of, I would say the top 5 are kind of oddball names. Dominion's a real investment. It's down. Gilead, Newmont Mining, FireEye, AT&T, ever since the merger issue, the discovery issue or merger or sell-off, spin-off, not merger. Roblox has been on fire. I just saw it bouncing in here. Kramer had him on last night, did a great piece. I thought for sure they'd be in the green today. There have been PhD level studies correlating what Kramer's talking about on his show to how they perform the next day, and to a T, all of them found no correlation. So it's kind of interesting, right? You can have the number one individual stock guy squawking and people aren't listening. So it is what it is. All right, that is it for that. We're going to go over to talk back to no trade this morning. Sorry, we didn't get you one there. All right. There we have it. Investopedia. MOIC. Okay, so this is used in private equity a lot. So if you're in a private equity placement, you'll hear MOIC and IRR, and we don't normally talk in those terms. So the realization multiple, so it's really when you back out all of the percentages of return, you're looking at, look, if I put $50,000 in with Blackstone, and and they tell me they're going to keep it for 7 to 10 years, and then I get my money back. Well, if I put 50K in and I get 100K back, that's a 2 multiple, right? So it's like everybody can kind of understand that, right? So that's a little easier when they say, well, the IRR was 8.2%. You're like, okay, so at 8.2%, rule of 72, my money should double in 9 years. It's like, okay, that makes sense. They held it for 9 years. Got it. So that's really, you will always see a MOIC when you're talking private stuff, because people aren't quite as savvy to understand IRR. So it's a little just easier to talk dollars in to the black box, dollars out of the black box, and then what's that fraction, right? So if I put 50K in and I get 50K out, well, then that's just a 1, right? Because I got all my money back and that's it. If you held everything for 1 year and you put $1 in and got $1.10 back, that'd be a 10% return. Everybody understands that. You get into other things then, and that's more difficult to understand. Another one that's difficult to understand is IRR. Again, you have to have fancy calculators to calculate this stuff. And that's why when people are like, what is the return on my account? I'm like, I can give you a rough return, just doing some basic math. Which is probably close enough for most people. But if you really want the exact return, then you got to do this. And internal rates of returns back out cash. So when you think of an IRR from like Blackstone, they call the capital in all at once, right? Over time. So if you commit to 50K, they're going to bring it in, 15K up front, and then 10K 6 months later, they can call that capital. Well, if they just started the 50K from January 1st of 2020, and then that counted against them, well, if they take the capital on, they have to turn it. So they don't take the capital until they have a use for it, right? So if it sits in cash, that doesn't count against them like it would for the rate of return, right? So, but they also allow you to invest that money elsewhere. And when they do the capital call, then you free that money up and put the money in. So it allows money to keep working. But as far as the actual Blackstone return, instead of over the course of this 7-year investment, it having a hard start and a hard finish, it now has a running start and a running finish as they distribute stuff back out, give you your capital back, and then your profit. So when you think of the cash flow, if you do a cash flow diagram, a bunch of arrows in and a bunch of arrows back out, which makes the math like boom, right? Because you'd have to account for all of that. But why I bring that up is the IRR is exactly the return that you're getting over those years. Where if you just do ROI, it's a little sketchy. You see some of the same math with your mortgage, right? You have your interest rate and you have your actual your APR and your interest rate, and they're always different. You're like, what's going on? Well, that math is involved in that. So, all right, got long-winded today. Thank you so much for listening, and did kind of talk to some advanced topics. If you want to know more about private equity stuff, again, accredited investor will get you in. But it's I like it. It's black box stuff. You put some cash in, and then you get updates quarterly, and you don't have to worry about it. So it's really good for people, especially if you have an equity event where you take on a bunch of capital and you're like really worried about watching it in the app float up and down for your, you're like freaking out. It's best to tie it up in these things. That way, you don't need to freak out because they've got it. You don't have to worry about it. So, all right, that's all I got for you today. Thank you so much for listening in. We will see you guys back tomorrow.